So let's add another voice to the conversation. Let's welcome in Ann Sonders. She is Schwab's chief market strategist, joining us by phone. Ann, it's nice to have you back.
Thanks for having me.
We're about to embark on the last week of the first half. So what's going to be in store in the months ahead, do you think?
Well, I just published actually yesterday my second half outlook, and it obviously hinges to a large degree on both trade and the Fed. And I think the jury's still out as to whether the proxy here is a 1998 kind of situation where it's insurance cuts, or in the case of 98, they were actually combating the implosion of LTCM, and related to that, the Asian currency crisis and Russian debt default. And it did elongate the runway to trouble both in the stock market and the economy. Or is this more like a 2007 or 2001, where the Fed steps in, cut in both cases by 50 basis points, but we were already heading into a recession and it was too late to stem the tide? And I do think trade probably is an important needle mover in the near term. I also think that if we are heading into a recession, we're probably already in it, because when the NBER dates them, they go back and they date the beginning closer to the high, not just at the point where they had the epiphany that we're in one.
You think we are?
No, not right now. But I think my point is that if we head into one, and I think it's more likely if there's no trade deal, and in particular if the remaining tariffs kick in on the $325 billion, because that's a much higher bias toward consumer goods. And I think under those circumstances, it's hard to imagine a scenario where you reignite corporate animal spirits, kick in the CapEx-led part of the cycle. So if I think the next round of tariffs, I think makes is an important distinguishing factor as to whether this is just a slowdown or something worse.
Yeah, but you're looking for more volatility in the months ahead, just given everything in front of us, whether it's geopolitics or the trade situation, and then there are other things to be concerned about as well. Does that all add up to more volatility?
Yeah, in fact, what you've seen in the last year and a half, where this is sort of the fourth high since January of 2018, and each high has come with a successively lower percentage of stocks that are above their 200-day moving average. So that's not the only measure of breadth. Traditional AD lines still look pretty decent, and with those successive new highs that have had a little bit weaker breadth in terms of stocks at new highs, or at least above their averages, you've also seen a pickup in volatility. So it's not yet measured in a persistent pickup in the VIX, but I think the kind of short-term bouts of volatility, the intraday swings by virtue of what we might see on Twitter in the course of a day, I think will continue to be a characterization of this environment heading into the second half.
What if we just distill everything down to a simple fact that the Fed is seemingly about to embark on a rate-cutting cycle, and history says when they do that, you buy stocks? Really?
So you wanted to buy stocks in 07 when they first cut, or in 01 when they first cut?
Well, I mean, you're saying that now is like 07?
I don't know. I'm saying it could be a 1998 situation where they're reacting to a short-term crisis, and it did fix the problem. But you also had, other than 1998, you had a 50 basis point cut in 07, you had a 50 basis point cut in 01, and then you had bear markets because it was too late for them to halt the path toward recession. I think the jury's still out as to what scenario we're looking at here.
Interesting.